Well, Saturday, this Saturday, the 27th of April, is Freedom Day, and this is an annual commemoration of the South Africa's first non-racial democratic election since 1994. Now, the elections back then obviously shifted the country towards a construction of a new political, social, and economic order. So, as you can see with today's topic, financial freedom through investing in equities, that's our theme today, obviously around financial freedom. So the question I have for you, how are you shifting your financial situation to one of financial freedom? Okay, so in this webinar, we discuss how to do this as a long-term investor. Those of you that don't know me, my name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. So this is the contents we're going to talk about quickly. Very briefly, only 6% of the population ever achieve financial independence, and the big question is there, why? What happens to the rest of the 94%? And we're going to discuss what is financial freedom, and then how do you invest in equities to achieve financial freedom, and then just very briefly touch on some tips how to choose those shares that will help you on that path. Okay, so just let me grab some water here quickly. So we're going to kick off with the challenge for most people. Only 6% of people achieve financial independence. People also know that some of the stuff is basic, but I also believe that most of the people don't know the stuff, or we don't think about it. Hence the low level of financial independence. And this is not only South Africa; it's anywhere in the world. Okay, so many years ago, a life insurance company did a survey of 100 people now aged 25. And I found that 40 years later, at retirement age of 65, that one person will be rich, 5 people will be financially independent. That leaves 94 people will not be financially independent. So those 94 people will include, obviously, some people will be dead through car accidents, old age, you name it, okay? 34 people will still be working at the age of 65. But also, 48 people will be relying on charity or family to support them. So the big question is why? Okay, and I know again this is common sense. These are just some of the reasons that you can think of. 6 reasons why people will not achieve financial independence. Having credit card debt, I call it bad debt, and paying the minimum monthly payment, or they're unable to make the minimum payment. That's number one. Having credit card debt, and we'll talk about it again just now, about credit cards. Number 2 is overspending, living the champagne lifestyle on a bare income, as I would say. Retail therapy. Okay. Not having money saved for emergencies. When something happens to your car, something happens medically, you don't have those funds, and that's what puts you backwards. Now you have to start dipping into your bond, and things like that. The money you're supposed to spend on your bond payments, you dip into for emergencies. Failure to save and invest for their money, and you'll see on the next slide regarding retirement, and that's quite interesting, a survey that 10X did. Not having financial goals, and this is, I think, one of the big problems with most people. And I was reading an article in today's Business Day about financial literacy in the schools. They need to bring it more and make it more prominent. And having bad or negative attitude about money. There's a lot of myths or sayings. Money is the root of all evil. That's a misquote. It's the love of money is the root of all evil. Things like money can't buy you happiness. And I always say, gee, but it's right up there like with oxygen. There are a lot of other things, but there's negative attitude. So these are just some of the reasons why we have that scenario. As I say, there's a survey done by 10X, this is October last year. 62% of people are not confident that they'll be able to draw an income in retirement. Now, yes, I'm talking about retirement. This should be a long-term goal. I believe that achieving financial independence, it should be like a shorter-term goal. And I believe also if you achieve financial independence, you'll have a happy retirement. But going back here, 41% of people made no provision for retirement at all. 62% do not have any form of retirement plan. 53% do not know how much the pension is worth. Okay, you come down here when you start things, look at the women's side, Frankie's and those, and Angelique. Okay, very few women, a mere 16%, reported investing their savings in order to grow their wealth. So this is all just very worrying, and hence the reason for this webinar. Okay, so I want to highlight something for you also. Yes, the long-term goal is retirement, a happy retirement, but what's important also is that you cannot become financially free if you're relying on your salary or your savings or hoping to win the lotto. Okay, so stop confusing savings and investing. Saving is typically a short-term goal, like for a holiday or a deposit on an asset, while investing is aimed at more wealth building over the long term. Okay, so I mentioned just now about credit cards. Okay, and I'm making an assumption here about credit cards. Credit card debts overwhelm most people, and they delay you starting any form of investment strategy. So when you pay off your credit card, and not only paying off the minimum, you're paying off as much as you can. Remember, you pay on average about 24% interest on that. If you pay that interest, that credit card, you're basically getting that kind of as a return. Not many places you can get a 24% return. Get rid of a credit card, and obviously that's a very good investment. Now you can take that money now and start building up a what I call an income generating asset. On more of that in more detail. So yes, some of the stuff I have taken from Robert Kiyosaki. It's a guy that I really enjoy. I do a lot of his courses. I've read most of his books. But it all comes back to these 4 ways to produce income. So he talks about the cash flow quadrant. And this is very interesting. Some of you guys might know this, some of you might not know it. 95% of the world's population is on the left-hand side. You're either employee, you have a job, or you're self-employed, you own a job. Okay? So 95% of the population is on the left side. Okay? They also only earn 5% of the world's wealth. Whereas on the left-hand side, 5% of the world's population earn 95% of the wealth, and these are the business owners. They own a business system, or they're investors. They own investments. Okay, so this is where I want you to start thinking about changing your mindset, and this is where you want to be, on the right-hand side of the quadrant. Okay, the other quote from Robert Kiyosaki, and I find, and this is also the underlying theme regarding today's webinar. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. So again, that's why I want to highlight this importance of financial freedom. It might be a simple topic, but I want you to think about it today and start talk. If those of you that have children, discussing the importance of this with your children. Okay, so let's move on to what is financial freedom. So becoming financially independent is not a stroll in the park. You know, if it was easy, as I would say, we would doing it. But it takes time, it takes courage, it takes focus, it takes knowledge, it takes a different mindset. And more than anything, it takes commitment. And this is what I want to highlight for you guys today also. So those of you who want to embark on this journey, number 1 is your commitment to that. So investing wisely can be a useful tool, but it's not guaranteed. And certainly not for those addicted to immediate gratification, short-term gratification. So financial freedom is an ambiguous and subjective concept, as one man's financial freedom is another man's pocket change. So you need to define for yourself, what does financial freedom mean to you, as well as what does financial independence mean to you. I'm going to highlight in the next few slides. There is a difference, and I want you to think about along those lines too. So except for the idle rich, those of you that are on this webinar that are the idle rich, financial independence is generally achieved through hard work. Okay, so let's look at 6 reasons or 6 benefits of achieving financial freedom. Again, this is not rocket science, it's common sense, but I believe that achieving financial freedom, financial independence, first of all, and you'll see in the next slide, we'll talk about financial independence, how to achieve that. But to me, financial independence will lead to financial freedom. It's that freedom of choice. Okay, you'll have happiness, you'll have more options in life. And I always say it's freedom of choice. You can do what you want to, when you want to, how you want to, who you want to, and when you want to. You can retire early and have a happy retirement. You can travel. I love traveling. You can travel to any country you want. You're less stressed. Obviously, your relationships might be better. Obviously, there's no money worries, and that's one of the biggest reasons for divorce is money. You live more comfortably, and you can have more hobbies. I love to have more time freedom, so I can spend more time on my hobbies like triathlon, takes a lot of time doing training, and also love attending a lot of personal development seminars and webinars, and I love reading. So that's what I like to spend my time with. Okay, so those are just some of the benefits. As I say, it's common sense. Most people, you ask them what is financial independence, you'll get a lot of different questions, different answers. But to me, bottom line is being in a situation where, you know, they always tell us put 10% of your money away to some form of investment that hopefully be able to retire on one day. It's reversing those roles around where 90% of your income is coming from your investments and maybe 10% from your salary. And that is, for most people, what is a financial freedom. So the idea here is to, have a plan, and that's what's very important, is to have a solid plan how to reach that goal. But bottom line, it all comes back to money management, and this is a concept I learned a long time ago. I learned from a guy called T.R. Ecker, Millionaire Mind. He spoke about the 6 money jars. So I've tried to implement that in my life, and I've tried to use it for my children. But basically, and this is just a hypothetical example again, let's say someone's earning 20,000 Rand income per month. The idea is to split this up right in the beginning. So it's a bit of like a budget. So let me bring my cursor in here quickly, my spotlight. I always believe pay yourself first, okay? So it goes into what I call the 10% financial freedom account. Pay yourself first. So that comes back to that commitment. And also important when you think, geez, I can't afford to pay myself first this month, ask how big is your why. So this is what I call the golden goose account. This is the most important bucket or jar you want to look at. This is how you're going to build your passive income streams. This is your never spending capital. So if I'm putting 10% in that, I'm putting 2,000 Rand out of my income every month into my money jar, my golden goose. The idea is to discipline yourself to have 50% of your income spent on necessities. And this is where the challenge comes in. This is where we talk about your rent, your bond, utilities, your food, your clothes, all that kind of stuff. So yes, 50% out of my 10,000, out of my 20,000 will be spent on that. And yes, remember, this is an idealistic way of looking at it. And this is what you want to strive for. 10% will go to what I call the give jar. This is your charity or tithing. Some of you might go so far as to start putting this money aside for Christmas, for family and friends' birthdays, special occasions. So that'll be equivalent of 2,000 Rand. Another one I always find important for me is put 10% away for what I call further education. Okay, this is personal development, reading the books, doing the trading courses, doing the seminars and that, and that's 2,000 Rand. Okay, so it's just having the discipline to put that money aside. And then 10,000 Rand, what we call long-term savings. This is a nice to have purchases. Maybe you don't want to buy on anything on credit. You want to buy that TV, you save up towards it. It can also be the emergency fund, can also be the children's education. Okay, again, 2,000 Rand. And then very important, you've worked hard for your money. I always believe in having 10% what I call fun money or play money. This is where you nurture yourself. When you go out for your spouse, have an expensive bottle of wine, have that massage, that weekend away. Okay, so that is the idea. Okay, so it's what's important is that the plan, what you want to do is implement it. Okay, but very important, I want to highlight for yourself, and this is, again, pay yourself first. Okay, that's a very, very important concept to understand. So go one step further. Now you want to start looking at what is financial independence. Okay, so I'm bringing back Robert Kiyosaki. There we go. So Robert Kiyosaki, again, says the key to financial freedom and great wealth is a person's ability or skill to convert earned income, your salary, into passive income and or portfolio income. So he has a 3-step simple formula. Buy assets that generate the cash flow, and then that cash flow from your assets will pay for your living expenses. Once your monthly cash flow is greater than your monthly living expenses, then you're financially independent. Okay, so that is the financial independence part. Now, what's important to understand is, while this will allow you to be financially independent, it doesn't always make you free. And this is where the concept of financial freedom will come in now. If you don't change your mindset, okay, you'll fall back into what we call a fear-based scarcity mindset. And you can easily lose your money again. So a lot of people fall into this little mindset where they get worried about money and the investments and start making bad decisions, and obviously that hurts your cash flow. What's even worse is that they become miserly and miserable, even with lots of money. So that is not financial freedom. So the idea here is, as I say, that changing your mindset is where, instead of being controlled by money, it's more important to remember when it comes to money is what money can do for you. Okay, it's what money allows you to do and be. Okay, money is just a tool for attaining certain things in your life that will make you truly happy. Now that is financial freedom. So that's what I want you to understand today. Achieving financial independence, define it for yourself, achieve financial freedom, and also put a deadline on those things for yourself. Okay, so what's important now, how we do this. So we talk about regular and active income versus passive and portfolio income. So yes, I'm talking about the guys earning a job, and we talk about a salary. So on the left-hand side here, we talk about a active income. You're changing your time for money versus your money working for you. Okay, on the right-hand side, income grows linear. Yeah, we grow exponentially. Income stops if you become disabled. Yes, you might have insurance policies and things like that. Most people don't. Okay, but income will stop. Income will continue growing indefinitely with portfolio income. On the active income, you become a victim of income chasing versus a master of wealth creation. Yeah, you become dependent on a job. Yeah, you achieve true financial independence. Not enough time to enjoy your income. Okay, yeah, you have time freedom to do what you want to. And then obviously this side here, if your work stops, the income stops, and with passive or portfolio income, it continues to be created. So how do we do this? And this is again the idea I want to share with you guys today. So it starts off with your income sources. Again, I'm assuming most of us have a job, 9 to 5 job, and our income's coming either from our salary, and maybe once in a year we're lucky to get Christmas bonuses, but that's our income sources. Minus our expenses, and using those 6 jars again, I would say pay yourself first, and then we break it all those different jars, okay? So what's left behind will be your savings. And that's why, again, I want to stress, pay yourself first. Okay, so that savings you set aside. And most of us have been in a situation where we start building a share portfolio. And in this sense here, we're going to talk about dividend paying shares. And then later on, we start looking at property stocks, which also pays out a high dividend yield. And then as we build up more and more equity and things like that, yes, now we can start looking at buying properties and starting our own business in it. But ultimately, we start building what we call income generating assets. And from that, that'll give us our passive income and be in a situation where we be replacing our job. And that's what I say, this is the golden goose. We never killed our golden goose, and this is the golden eggs. Okay, I hope that makes sense to you guys. So that's what I highlight for you. And there's different expenses. I'm taking monthly expenses from 5,000 Rand up to 50,000 Rand, just as a example. How do I achieve financial freedom? Obviously, when my passive income is equal to my salary, my expenses, or greater than my expenses. So yeah, example, going back to my 20,000 we used in those different jars. If my monthly expenses is 20,000, the income I need would be 20,000. So multiply that by 12, my passive income analyzed will be 240,000. Now, if I'm using a buy and hold investing strategy and I'm investing in dividend shares, and my average dividend yields of 5%, I will need a 4.8 million Rand portfolio to get that stage where I'll be able to get 240,000 Rand a year. Okay. So how do I get to 480,000, sorry, 4.8 million? Okay. I need to build up some savings. So over the long term, the idea here is that I need to save 80,000 over 5 years to get to 400,000. So that's as an investor, okay? giving you that 5% dividends. And I'll talk about how do you get those kind of shares. As a trader, okay, yeah, we're talking about 5% per month. So analyze that, it's 60% per year. And some of you are going, wow, that sounds crazy. It's impossible to do. I can tell you now there's many shares will go 5% in 1 month, okay? So what's important, and this is what I want to highlight for you guys today, I'll be honest, it's hard to do this with equities. I find it's easier to do it with derivatives like CFDs and single stocks. Why? The secret there is leverage. It's a geared product. Okay, it's more capital efficient, number one, and number two, it's obviously cheaper to trade. Okay, so you bring down 50% deposit, to have 100% exposure, your gearing is 6 times. So I'm going to spend, obviously, in this presentation today, spending most of my time on the buy and hold investing strategy and spending time on the dividends. Okay, how to find those dividends. Okay, I will be having webinars coming up soon again on CFDs, how to create that kind of income all the time. Those of you on our WhatsApp group for trading, you'll see that our latest one on MTN is giving you more than 5% this month alone. Okay, so how do I invest in equities? So first of all, what's important to understand is that investing in shares is more a way of multiplying your wealth over the long term. Okay, so let's first of all explain the difference between an investor and a trader. Some of you might be on this webinar for the first time. This is the way I look at an investor and a trader, and you need to ask yourself, what am I, investor or trader or both? And ideally to be both. I have an investment account, mainly in equities, and I have a trading account, mainly in derivatives. Okay, so when we talk about investor, your time horizon is 3 years plus. As a trader, your time horizon is obviously the opposite, anything less than 3 years. The reason why we have time horizon 3 years plus, because of capital gains tax. You buy and hold a share for these 3 years. After 3 years, decide to sell, then capital gains tax applies as opposed to income tax. So your style of investing will be more of a passive management. You might be looking at your portfolio once a month, whereas trading take more time, be more actively involved, managing more the risk. As an investor, you'll be using more the fundamental analysis. You're looking for value, looking at more the numbers, as I always say. As a trader, using more the charts, looking at price. Price is your number one indicator. But as an investor, your main goal is obviously capital growth and dividend income, whereas with trading, it's more capital, your focus is more on capital growth. As a buy and hold investor, I'll have low brokerage costs. As a buy and sell trader, I'll have higher brokerage costs. Hence the reason why I say trading CFDs and single stock futures is a much better option. And as again, I mentioned just now, if I buy and hold a share for these 3 years, I've decided to sell after 3 years because of the share might be expensive or something has changed fundamentally, I would only sell then. But understand that your capital gains tax is much lower. Effectively, it's about 18%, whereas with income tax, you'd be paying as more as on profits, up to 45% of your profits, depends on your income tax level. And then when you have dividend income, remember we're talking about dividend withholding tax. So after tax, we're looking at 80% tax-free on your dividends. Okay, so first thing that always comes to people's mind, and I get this question quite often, is how much do I need to get started? And you saw just now what you need for 20,000, you need at least 4.8 million. But let me talk you also through small cap stocks. Now, a lot of people want to know, is it if it's possible to become rich with a penny stock? When I say a penny stock, there's an American expression, but you need to define for yourself what is a penny stock. First of all, it's highly probable or not very likely to become very rich with penny stocks. There are opportunities once in a while, and you'll see some examples here. So some people define a penny stock as any share lower than 1 rand, okay, 100 cents. But some even suggest 5 rand or 10 rand as an example. But let's confine it to our definition to anything as a penny stock. I look at anything outside the top 100 from a market capitalization or from a size. We talk about the number one stock is the AMD Beverage, which is like nearly 2 trillion. That's the size of the company. And the lowest one, number 100, I can't remember which company it was, but I think it was about 11 billion. So anything below 11 billion would be considered a small cap stock. And that's what I would consider as a penny stock, anything below outside the top 100. But going back to your example here, way back in 1987, if you had taken 10,000 Rand and you bought PSG shares at 60 cents, okay, way back in 87, you'd have got about 16,667 shares. Now, again, if you were committed to a long-term investment, would you have had the discipline to hold on to the share when it dropped all the way down to 18 cents? Your 10,000 Rand now was only worth 3,000 Rand. Would you have stayed the path? Okay, that is the big question to understand. Okay, would you have stayed it for nearly, what's that, 7 years? Okay, and then it broke up above it and then it ran. So your 16,667 shares until about a week or so ago would have become, your 10,000 Rand would have become 4.4 million. That's just investing in PSG. And along the way, PSG had paid out dividends equivalent to cumulative of 17 Rand 96, which was nearly just under 300,000 Rand in dividends. Okay, so that's the advantage of getting in early as a penny stock, but buying and holding as a long-term investor. We're talking about from 1987 till now 2019. Here's another example, Capitec. Way back in 2002, okay, your 10,000 shares would have bought you 5,556 shares. Would you have had the discipline to hold on to the stock when it dropped all the way down to 80 cents, from 180 to 80 cents? Okay, you've only been worth 4,445 Rand. Okay, now you would have been worth 7.7 million. Okay, so that's the thing about a long-term investor. Buying onto the stocks that you believe has a potential and ride them. Okay, and in the meantime, also, again, you would have got over 300,000 Rand in dividends. So the question today, yes, how do I find these stocks, these penny stocks or these small cap stocks that might give me the opportunity? On our website, if you click on the research hub, go click on recommendations, you'll see that these are recommendations. I don't know, highlight for you. These are the small cap quants that we just highlighted now. The last 4 days, a few days, okay? There are 4 companies that came up: Signia, Astral, Peregrine, and Alexander Forbes. Now, I like Signia, okay? Number one, you can see the PEG ratio from a valuation point of view is green, so it's undervalued, okay? But also, what I find interesting is that this company is paying out good dividend. It has over 5% dividend yield, number one. Number two, it's profitable. Let me get my notes here quickly. When I say profitable, its return on equity is more than 26%. Dividend yield, as I say, is 5.7%. It's got no debt. From a valuation point of view, as I say, it's got a PEG ratio of 69. How do I calculate a PEG ratio of 69? You look at the PE, the price earnings multiple, which at this point in time is 13.7, and it's growing its headline earnings per share by 20%. Divide 20 by your PE and you get a PEG of 69. Anything between 35 and 75 we consider as undervalued, and that's what's color-coded green. It's undervalued. That's number one. Number two, obviously price NAV, that's 2.4, which we still consider is undervalued. Looking at its return on equity of 26%. As I said, it's got no debt, it's got cash flow, it's positive. And also what's important, it's got a quality rating of more than 70%. So those are all the fundamentals. So the numbers look good, number one. And number two, technically, I like this company. This is until yesterday. You can see it's been in the long-term downtrend. It looks like it's poised for a breakout. Okay, that 50-day and the 20-day moving average is crossing, so we're confirming a change in trend. We've broken above this resistance trend line. Look like we're about to break up this one here. But I just want to highlight for you, fundamentally and technically, it's a stock that you might want to look at. Yes, it's trading at 10 Rand. Okay, you go buy 10,000 Rands worth of shares now, and you leave this for long term, it can easily go back to its 22,000 Rand level. Very, very easy, doubled your money. But think about it long term also. This is the kind of company that you want to build up a long-term portfolio. So that's the small caps. That's number one. Number two, what about dividends? On our website, again, under Research Hub, recommendations, these are our top 10 dividend companies. And you'll see, and I'll highlight it for you in the next stock, these top 10, 5 of them are banking stocks and 5 of them are financial or insurance companies. Okay, MMI, Metropolitan Momentum Holdings, the old Metropolitan, 9.51. Clientele Life, 7.8. Okay. Liberty Holdings, 6.64. ABSA, so Old Mutual, 5.64. If you add all those up and you average it, these top 10 will give you more of an average of more than 5.87%. But the point I want to make here, yes, they're all financial shares. So you want to put all your eggs in one basket. You want to diversify. So there are a lot of other companies that also fit that criteria. Companies like Vodacom has a dividend yield of 5.42. Lewis has 5.29. New World, 5.7. You can look at some of the resource stocks. Kumba is 5.31. Exara, 5.3. Okay. So remember, you want to build a diversified portfolio. But these are the opportunities highlighted for you. You can do further investigation. So I'll highlight some very quickly, some tips how to choose these kind of stocks. Depends on, first of all, your style. Now, I'm running out of time. I'm not going into too much detail here. There's different styles. We talk about value investing, growth investing, GARP, and dividend. I personally have a bit of a fruit salad style. I have some stocks that are value stocks, some of them are growth stocks, some are GARP, so growth at a reasonable price. That's what it stands for there. And then all my stocks, I always trying to go for stocks that have that are paying at least 5% dividends. So when you get this presentation, please go into more detail as an investment style and choose a style. As I say, I like to have a blend. Doesn't matter what I'm looking at. At least I've got a strategy. Also very important is when you look at all these different stocks, is look at things like consider the price and valuation. Never buy a share on price. You look at valuation. Okay, PEG and price and NAV, all those kind of things help you to decide if the share is cheap or undervalued. And very easily we look at what they call a PE ratio. Anything below 15 we'd consider cheap. Anything over 20 be considered expensive. I suggest go through our online tutorials. There'll be a link on it just now. Goes into more detail, explains how to use the PEG ratio. And past webinars, I have explained that before. Now, what kind of share you're talking about? Are you looking at a new growth company? Companies that's basically investing all its retained earnings, not paying out any dividends, as opposed to a blue chip company being around for a long time. So, what kind of company are you looking at? A blue chip share or a green chip? Okay. So those are the kind of things you also want to bring on consideration. Take in consideration. Cheap is not always good, and expensive is not always bad. So when we talk about a share that's cheap, the share was 5 Rand and now it's 5 cents. There's reasons why. The company might be not growing as fast as it was in the past, might be loss making, basically losing market share, whereas expensive stock is expected to grow more. And obviously market rating companies, the market rating it higher. But you need to, again, look at valuations to take in consideration. Evaluate financial health. It's all very well to buy into a company that's growing, but just what's the quality of its health? When we say health, look at its assets. Look at its things like where's it generating its income from? We also look at things like cash flow. Look at things like interest cover and things like that. Okay, very, very important. Look for revenue growth. This is what they call top line. Is it growing more than inflation, or just keeping in line with inflation? Same as bottom line. Well, what is bottom line? Looking at how does the company control its expenses. Okay. Revenue, less expenses. We talk about profit margin. So how is the company controlling costs? You can only cut so much fat. Thereafter, we have to do something else. How are they expanding those margins? And very important, how much debt has this company got? So I always like to look at interest cover, and we talk about interest cover more than 3 times for a large cap stock. For small cap stock, I like to have interest cover more than 5 times. And very importantly, is a dividend, and is a dividend growing? So is a dividend income, number one, and number one is a dividend growing. So a more how can I say, a more mature company will be paying out dividends more often, whereas a new company that's be reinvesting retained income to grow faster. So those kind of things you want to look into. Okay, so guys, I'm running a bit over time, so let me just go quickly into the summary and conclusion. So main thing I want to highlight for you here is that define financial independence for yourself. Okay, bottom line, you want to get the situation where you have passive income, and you want to create passive income from dividend paying shares. And I forgot to mention the rates, which is the property companies. You go into our website and go look and go search for all the real estate. You'll see most of those, or most of them, are paying out more than 5% in dividends. So yes, it's just another asset class you're looking at. You're having exposure to commercial property. You're going to go into things like Bowen, which is more residential property, but you can see all of them pay high dividends. That's also the way they're structured. So most of you will be starting out with dividend paying shares and then add on as you learn more about the market. Okay, so in conclusion, obviously what's important to understand is your investment style, and having certain criteria help you scan through the gravel to find out gold nuggets. I like to look for shares that are undervalued, profitable, have manageable risk, and are paying out growing dividends. Okay, so in conclusion, or call to action as such, I suggest those of you who are quite new to this, go review the online tutorials, Understanding Market Fundamentals, goes into more detail those financial ratios, and then develop an investment strategy for yourself. And then just as a side, to find a financial independence for yourself or financial freedom, and then set yourself a financial freedom date 5 years from today or this Saturday, 27th of April 2024. You want to be financially independent. I like to also use the 4th of July as the day of independence. Okay, so bottom line, when it comes to money management, I find the easiest way is to pay yourself first. And that financial freedom account, the most important bucket you can think of today. Those of you that don't have a share trading account with us yet, go register and open up a financial freedom account. We are there to help you along this journey. And so from my side, happy trading. Okay, let's see what kind of questions you have here quickly. Cool. Okay, here's a question here from Jeffrey. It says, can I start with 10,000 Rand? Well, Jeffrey, yeah, you can, but obviously understand that you're putting all your eggs in one basket. Ideally, you want to buy one share because your cost, direct clients, direct minimum fee is 98 Rand per trade. So your cost is roughly about 1%. So yeah, start at one share, and then, but over time, add more funds. Ideally, to get a situation where you've got 100,000 Rand, you've got 10 stocks. But again, Jeffrey, it takes commitment, it's going to take hard work. Most importantly, also, it's going to take your discipline. Okay. Danny, do I use my entire bonus each year to invest? Hey, how important is financial freedom for you? But again, goes back to that bucket. Use those 10 buckets, split them up. So yes, you want to pay, hopefully you don't have any debt as such. You want to get rid of your debt as soon as possible. But then have some money, enjoy some of your bonus. 10% put into your play account and split it along those lines, Jenny. I find the easiest way to do that. Hope that answers your question. Cool. So yeah, guys, that looks like it for most people. So from my side, I hope I've given you some food for thought. Any questions you guys have, please contact us on our email, wealth@psg.co.za, or our line there, 0860 000 368. But if I could just give you one takeaway, please teach your children about the importance of having financial freedom. How do we get there? By creating passive income. If we can start teaching our children at a young age, I believe that our economy and our society will be much different. So from my side, thank you very much. Thanks for being on this webinar. Until a month's time, we'll talk again. All the best. Bye for now.